Let's talk money.
Hello and welcome to Let's Talk Money. I'm your host Surabhi Upadhyay, and this is a special show for a lot of you who are wondering what to do in this market fall. Yes, it's been a challenging start to the new year as far as the equity market is concerned. The market consolidation and correction has continued well into January and now halfway into February. The Nifty is down 12.5% from its peak. The mid-cap index is down 17% and the small-cap index has lost about 19% from its peak. Now, this is just at the index level. Investor portfolios in many cases have been bleeding a lot more in the last couple of months. So given this mayhem in the market, how should investors shape and modify their own portfolio strategy? Is this the time to buy more, to sell and book some profits, or should you just sit tight and do nothing? Or maybe should you just rebalance a little bit? Well, to help us answer these questions and figure out the way forward, we have Dhirendra Kumar of Value Research joining in. And in a bit, we'll have with us Radhika Gupta of Edelweiss Mutual Fund, as well as Aashish Somaiyaa of White Oak Capital to join in as well. So we'll start with some of the basics, because when you look at the numbers are always difficult. Dhirendra, great to start with you. And, I went on Value Research. And the thing is, we all know we're not supposed to look at short-term returns. Equity is a long-term story. But nonetheless, a lot of investors do go online and they check the 3-month return and the 6-month return. And then you realize almost every single fund is probably in negative territory. Your first thoughts in terms of what you are witnessing in this cycle that we're in?
No, any new investor who came into the mutual fund, or they started doing their SIP, or they invested lump sum, and large number of investors have come in the last 1 year. They might be unnerved by what is going on, but I think any investor who has been there for a little longer will understand that this is how it is, and this is how it has always been. And it all got triggered by the conversation on the small cap funds and the small cap stocks, that they look very pricey and it may be inopportune, or it may not be proper. But I actually went back and saw the 20-year performance, annual performance of all the small cap funds. And what I find is that every year, without a fail, the difference between the highest NAV and the lowest NAV is anywhere between 20 to 40%, which means from the highest level during the year, these small caps lose sometimes 40%, sometimes 30%, sometimes 20%. But despite that, the 20-year average return of small cap fund is little over 19%, which means that the return, and it turns out to be the best performing category over such a long period of time. Which means that the reward that investors get in small caps is not because of great small caps, but it is a prize for being able to withstand the madness of these small caps every year.
Okay, well said, well put, that these are the times which really test your nerves and your patience, and it's a question of how do you ride this sort of a period out. We do have with us now Radhika Gupta of Edelweiss Mutual Fund, and we have Aashish Somaiyaa joining in from White Oak. Ladies and gentlemen, thanks so much for being part of it. Now, I don't want to talk only gloom and doom. I also want to talk about the good news which came in the form of the mutual fund data for the month of January. And it's very clear that investors have kept the faith. They're not shutting down their SIPs. They're not shying away from putting more money in the markets, because we'll put those numbers up on the screens. 26,400 crores flowing in systematic investment plans. The flows into large caps have moved up by 50%. Small cap flows are month on month also surging. Radhika, your first thoughts on this confusion that's playing out in terms of the market correction?
I don't know why there is so much confusion. I'm very happy to see the data for Jan, but to be frank, I'm not surprised to see the data for Jan. We run decent-sized mid and small cap funds, and I can tell you, for us in aggregate, Jan was a better month than October, November, and December. What's happened over the last couple of weeks is, and we live in times, as Dhirendra said, a 20-30% correction in the small cap index in any given year is not a meaningful. I mean, it's par for the course. It's a feature of the product. It's not a bug that has happened. The problem is we live in clickbait times, in times of social media, where single comments, where things like this get exaggerated, and an environment of fear can come up, which is what I think has happened in the last 3 days. I've spoken to many investors who are latching on to single headlines, etc. The reality is that in January, people kept their faith. If I look at our own numbers in February, people are continuing to keep the faith, including this week. So I think you have to give credit to the retail Indian investor who has matured, and to all of us who've been having conversations that your small cap SIP is not a 3-year SIP, it has to be a 10-year SIP. And over 10 years, I repeat, the minimum return, I'm quoting our own fund in small caps, is 8% in SIP and 10% in lump sum. So if you keep the faith and remember that SIP is a long-term game, and I'm glad to see more investors are doing that.
Okay, got it. That's a fair point. But, one must also look at the other side of the story, especially a lot of the high-profile NFOs and the thematic funds. I mean, 2024 was a year of NFOs, and a lot of them were playing on niche themes. So, Aashish, that question to you, and we'll put up the data now. If we look at the 3-month return, and I know all of you will say, what are you doing, Surabhi? Why are you looking at 3-month returns? That's not how we play mutual funds. But that's what a lot of your investors do as well, right? 3 months, 6 months returns. They do look at the market on an ongoing basis. And there, the thematic fund category is down 12.5% for 3 months. In fact, it's wiped out the gain for the whole year, down 1.6%. But it's done really well on a 3-year period. And these are absolute returns, not rolling. So, Aashish, that question first. A lot of people who've put in money in recent NFOs and sectoral and thematic NFOs, they would perhaps be a little worried. What would you say to them?
Yes, Surabhi, I think when it comes to thematic funds, some amount or maybe a lot of responsibility lies with us, which is the asset management companies. Because when a thematic fund is being launched or when a thematic fund is being, spoken about, in public forums, it's very important to keep in mind 2 or 3 things. One is that we believe that, thematic funds should be invested only in a counter-cyclical fashion. So let's say the whole of 2024, and you quoted that some of them are down a lot in 3 months. That's because, you can see the names out there, energy, mid-cap, thematic, PSU, infrastructure. Now, see, all of this is happening on the back of very strong 3-year, 5-year performance. So what has happened is, on a 3-year, 5-year basis, all these segments have double-digit CAGR. But the NFOs have come in 2024. And like they say, you got to shoot where the rabbit will be. So if you invested in these thematic funds, you kind of shot where the rabbit was 2 years back. So thematic funds, one, you need to keep in mind counter-cyclical. So 2024, the thematic fund to buy was probably banking, pharma, IT, or ESG, good governance, high quality, those kinds of things. But people generally have been buying past performance instead of being counter-cyclical. The second thing is that when you invest in a thematic fund, it's very important that it is a theme. It should not be a narrow crack or corner or crevice or sliver of the market, right? It has to be something which is like 10, 20% of the entire market cap. So I would imagine BFSI is a theme, healthcare is a theme, I would imagine consumer is a theme, but I can't imagine transportation and logistics really to be a theme, right? It's pretty narrow. So just giving you examples, but I think these are some things to keep in mind when you invest in thematic funds. And if you invest at the wrong time, then you have to wait it out. It only prolongs your holding period.
No, okay, fair enough. Now let's dive straight into the most interesting part of this debate, which has been ongoing for several days now, mid caps and small caps, and this painful correction that we're in the midst of, right? Index is down 17% to 19%. Individual stocks would have fallen a lot more. Let's actually put up some more data on our screens, and these are numbers I pulled from Value Research. So if you're looking at the worst performing small cap funds, then the cuts are between 11.7% to about 14.5%. This is very short term we're looking at, extremely short term, just to see how investor psyche plays out. And if you're looking at the best performing small cap funds, then they're also down, but they're down less. They've fallen less. The cuts are between 5% to about 6-7%. Now, Dhirendra, walk in on this. Clearly, investors, at least in January, have voted with their money. They are not getting scared. They're still putting in money in mid caps and small caps. Would you say that this is the right approach? You buy when the market is correcting, including in the mid and small cap category?
Any investor who is not getting unnerved by this decline is a right approach. And anybody who is actually going to lose his sleep over this, it's a bad approach. So it's entirely a matter of how comfortable one is with, because, this small cap is not going to behave differently just because one naive investor has started investing in small cap funds. It is the character of this, and it is going to remain like this. For most individual investors, for most, whom we refer as the retail investor, the small guy who is investing and getting started, got attracted by the mutual fund Somaiyaa, and it has become seamless, easy. I think most investors should do well to the primary benefit of a mutual fund is to get diversification with convenience, and this is anything which is small. These are narrowly focused fund. I would urge investors to consider vehicles which are or funds which are broader. The multi-cap fund, the flexi-cap fund, the ELSS or the value fund, because, it will get you a broad exposure. Even, and somebody who is in his 40s, and getting started with mutual fund, he should actually start with a balanced advantage fund or an aggressive hybrid fund, simply because, good times, it's all nice. But the moment, and markets will be like this only. The falls are always steeper than, more sharper than the steady rise that they witness. So not to be unnerved by these declines, which is natural, is very important that they choose the right vehicle. And this is where I think advisors can play a very significant role.
Absolutely. Sometimes just looking at the numbers drives home a point that we otherwise hear so often, which is asset allocation. I want to pull up the chart which talks about the best performing funds in the last 3 months or so. The worst we know, I mean, they're all down 14-15%. Guess which are the best performing funds? Gold and silver. They're up about 10% each. And even in the year, 1 year gone by, gold funds, ETFs, gold ETFs and gold funds have returned anywhere between 30 to 35%. So that's the category. Now imagine if you had some of this in your portfolios and international funds as well, then obviously the pain of full equity would have been offset by the rise in some of these funds. Radhika, you want to comment on this? The beauty of asset allocation. In fact, some of my friends were also saying, oh, we're full equity. We didn't think of buying a gold fund. We didn't think of diversifying. Your thoughts?
I have always been an advocate of this thali approach, the good Indian thali approach to investing. It's called a balanced diet. And in a balanced diet, the reality is you have carb, you have protein, you have fat, and you choose the quantity that you do. Unfortunately, in times like the last few years, I've had investors come up to me and say, why do we need fixed income at all? Because some of the reality is that there is return chasing that happened. Now, you happen to pull up international funds, so we run, US Tech and China funds. The reality is we did not get very much money into international funds in the last 1 year. So while the screen has made money, I don't know how much money. In fact, we're now getting flows into tech funds. So I think much of the learning of these is, Aashish said this in the context of thematic funds, that as investors, we need to be counter-cyclical. We can't predict where markets are going, but we need to prepare our portfolios for events like this. That will happen by buying broad-based funds, by buying dal chawal funds, by having a broad-based portfolio, and by not being so obsessed with 1 month performance, 3 month performance, 1 year performance. I've been arguing with a lot of digital platforms. They should take down 1 year performance.
Okay, yeah, got your point that don't always chase return. Try and have that balanced, boring dal chawal thali, which is the balanced Indian meal, and maybe the balanced portfolio as well. But, we have to take a break. But on the other side, I want to ask the mutual fund experts about a lot of the new launches that happened on the passive side. These were smart beta funds, absolutely new products to the Indian market, and a lot of them are bleeding. So what should investors do? We discuss that after the break.
Let's talk money.
Welcome back. Here with us on Let's Talk Money. And this week we are discussing the big brutal market fall and whether you need to change anything around in your mutual fund portfolio. We're in conversation with Dhirendra Kumar, Radhika Gupta, as well as Aashish Somaiyaa. Now, before I go back to the panel, let's pull up what some of the new funds have done on the passive side. Now, these are called smart beta funds or they're multi-factor funds, something new for the Indian investor because they combine multiple factors put together. So, for instance, the Motilal Oswal Nifty 500 Momentum 50 ETF, there's a Bandhan Nifty 500 Momentum 50, there is a Kotak Nifty Alpha 50, there is a Mirai Asset Nifty Mid-Cap Small Cap 400 Momentum Quality 100 ETF. Yes, even my producer asked me whether I'm naming 5 funds together. No, this is one fund. It's combining multiple factors together. It's a new way of investing, something that's become quite popular in the Western markets. Now, a lot of these funds have been launched recently, and like the rest of the market, they're down in a significant way. Again, 3-month returns down anywhere between 14% to 18-19%. Dhirendra, for those who came into these funds, what would the advice be right now? Should new investors be looking at these funds in the first place?
No, one is that it is it's an avoidable thing for any new investor. And as I was suggesting that, most new investors should start at least with a diversified vehicle, if not with a conservative diversified vehicle. But that apart, there are two ways of looking at it. I have seen, many cycles, last 30 years, investors all, get excited about investments and make investments in mutual fund. Generally at the peak, after which they are generally disappointed as well. And if in their anger, they forget redeeming their investment, they end up being a winner. So what I say is that, mutual fund as a vehicle has all the checks and balances, even the worst of fund. Actually, if you picked an infrastructure fund, it would have been disappointing for many years. And eventually, if you're stuck around, it did pay off. Likewise, I have come across many funds where, people will have, so generally avoidable. People should go for the core, the heart of it, which is diversification, convenience, and being able to spread your investment. And, why this happens simply because, in mutual fund is the ultimate, consumer financial product where investment is sold as a story. And sold as a story, so what sells, the recent past performance sells very, strikes a chord with investors, and that is why they catch up. So, ideally, yes, you will have regret, but hold on if it's a broadly diversified, little diversified. Otherwise, if you're losing your sleep, square up and start all afresh.
No, fair enough, and I'm glad you raised that point because I'm going to ask that tough question to our other two panelists as well in terms of education. Because Aashish and Radhika, people who are running to office, they don't really know how much of the product, docket to read into. Their friendly, well-known advisor/distributor comes saying, this is a new fund, ye naya fund hai, acha hai, ye naya concept hai. And many times people just sign the check or whatever. They make the digital payment these days. So is the industry really doing enough? Has enough legwork been done before such smart beta, complex factor-based strategies have been launched? And what happens now? And are we spoiling investor experience for a completely new generation of investors? Aashish?
Yes, Surabhi, I'm not a big fan of any of these single factor funds. I'll tell you the reason. See, what has happened is that just like you said, thematics, a sector is also a factor. Like you said, momentum is also a factor. So I'm not a big fan of single factor kind of funds. The reason being that, they can be, you end up buying them at the wrong time of the cycle. People generally buy it after the performance has played out. The second issue I've learned is that, see, in the last 5 years, the winner rotation amongst fund managers and fund management companies, the winner rotation is so strong that in 2017-18, anybody with a growth style was doing well. In 2019-20, anybody with a high quality defensive style did well. In 21, 22, and 23, anybody with a cyclical value policy, macro style, they did well. So people realized, oh, okay, so first it was growth, then it was quality, then it's value, and then it's momentum. So people started learning that these winners are rotating when the factors are rotating, which means the factors are driving the performance. Oh, so now let me just buy the factors. See, there's a very important thing I read somewhere that the world is surprising. From time to time, the world will surprise you. When you keep on getting surprised, the learning is that the world is surprising. When you keep on getting surprised, the learning is not that I will use this to make better future decisions. The learning is not that next time I will not make this mistake and I will buy the factor at the right time. The learning is that you can't predict the factors. The learning is that you should have multi-factor, broad portfolio. So that's the key part. And I don't think it's just the advisors. See, I think today a lot of funds are just bought on some, a fintech platform. So I don't think we can, so it's not that the advisor or the MFD has to be blamed for that. There are everybody has a different journey as to how they reach a product.
Okay, fair enough. I take that point. Yes, so there's a lot of DIY investing happening as well. Now let's come, we're down to the last 2 minutes on the show. So let's come down to the moot question. Ki karna kya hai? That's, I think, what a lot of people are grappling with. Now, Radhika, this is not so much a big question for people who don't need the money, who just, who have the fill it, shut it, forget it kind of an approach. But for a lot of people who had sort of, computed a gain, who were watching the compounding, and maybe they're even nearing their goal, they are the ones who are confused, saying, should I now opt out, book the profit that is still remaining? Should I average, add more? These are the normal questions going through people's minds. So what would your advice and recipe be? And say for new investors, people who have more money to deploy, which are the top 1 or 2 fund categories that you will definitely, would advise in the environment like the one that we're in today?
Surabhi, I'll answer that, but I want to take 30 seconds because you didn't come to me with a question on factor-based funds, and at least we run a large franchise there. I find it a little unfair that the industry is going to evolve and you will see new investment approaches, styles, including factor-based investing come to the market. And this is good stuff, right? The only 2 things I would say is one can't write off the performance of factor-based investing as a category because it hasn't done well for 3 months. If you look at a fund like Midcap Momentum, it showed up in your screen, someone's fund, did very badly for 3 months. I would urge you to look at 3-year performance. So one, I think people have to look at these things with a long-term horizon. The second is people have to understand factors. This is not black sorcery happening. This is not black box happening. Momentum, for instance, as a factor is something that has been time tested in India for many, many years. So my only request to consumers is be aware of what you're doing and be long-term about it. Now, I think coming to the 2 questions, for existing investors, I actually don't push people to buy, sell. I always say that you don't make strategic decisions when you're in the middle of a storm. So if you can't do anything else, don't take action. Try and, we live in times where a single tweet from another part of the world can move markets by 2-3%, including a day like today. So don't be in a rush to take action in that state. For new investors, my advice, I think similar to what Dhirendra said, of course, these are better entry levels than they were, 3 months ago. But just be thoughtful about what you're doing. I think one thing the last 3 months can teach you is a little bit about your risk appetite. Nobody learns risk appetite in a bull market. They learn it in markets like this. And I repeat, start your investing with dal chawal funds, whether a balanced advantage, multi-cap or flexi-cap.
Okay, all right. Well, that's sound advice. Cannot argue against that at all. And I think it's very helpful at this point in time, coming as it does from industry veterans like yourselves. Thank you very much for joining in and for shining a light on what has been a bit of a tumultuous roller coaster for a lot of investors, especially the new ones. Thank you for joining in. With that, it's a wrap on this edition of Let's Talk Money. We'll see you again, same time, same place, with another theme next week.
Let's Talk Money